Hi, welcome to this video today, which is on a subject of a very simple and profitable Forex trading strategy. Now, in terms of the trading strategy itself, it comes from a member of our website. Now, in terms of this trade, it doesn't trade in exactly the same way as us. We all trade differently. We broadly trade in the same way. Now, in terms of this trade, I'm not taking any credit for his performance. He's done it all on his own, and he's made 111% in terms of capital growth since December of last year. That is an outstanding rate of return. Now, in terms of this trading strategy, it's based around a trading book in terms of the style of trading. Now, the trading book is actually the Zurich Axioms by Max Gunther, which we've often said is one of our favourite investment books as well. And in terms of picking out trades, it's based around George Soros's theory of anticipation, which we also like as well. Now, in terms of the trading strategy, it needs a certain psychology to execute it. Now, anyone can get the mindset to execute this type of strategy, but it's alien to most traders to do it. I'll discuss why in a moment. What I want to do is summarize the strategy in broad sweep, and then we're going to look at a trading setup. And we're having a chat on Friday. We're both looking at it. We'd probably trade it in slightly different ways, but we think offers excellent risk to reward. Right. Also, before I go to the summary of the strategy, and we'll look at the trading setup in terms of this video as well. Zurich Axioms is just such a fantastic book for any trader to go and read. And what I'm going to do is just the key lessons from the axioms. Obviously, I'll go through and we talk about the trading strategy, but I want to finish up with my favourite quotes from the book as well. A lot of wisdom in the quotes, and they're very motivational as well. Right, let's go to a storyboard and discuss all the points in more detail. All right, let's have a look at some key lessons from the Zurich Axioms. After we've finished with the key lessons, we will look at George Soros's theory of anticipation with an example in the market, as I think I said in my intro. Looks a really good risk-reward trade setup, then finish up with the best quotes from the book. And you can see I've done a quote about the book which says, if you have got the price of this book, stake it. It comes from the Investor's Chronicle. It is a wonderful book, one of the top trading books of all time, in my view. Very much against conventional investment wisdom, but there's nothing wrong with that. Most traders lose. In fact, today I don't think you even need to buy it. You can get it as a free PDF online. Just search the PDF. If you can't find it, I've got it, and just write to me. It's a great book because after you've read it, you actually, it gives you good education, but also gives you the motivation that you can win at Forex trading. It's a general framework of how to do the right things in terms of your strategy. And in terms of this video, the trader we're discussing, the actual theory for picking out trades is the theory of anticipation, which is one of the greatest theories in my view. Obviously comes from a legendary trader. Now, in terms of the key lessons from the axioms, I've talked about them in my videos before. Okay, I'm just going to go through them again in relation to the trader I'm talking about, and also subtle differences between our trading strategy here and his. I think the major difference is we're just slightly more conservative, but we broadly agree on how the market should be traded. Now, point number one, I've made this point so often, technical analysis doesn't predict anything. And I'm really bemused that the majority of retail traders think that it does. They look backwards on a chart, and that's going to tell you what happens going forward. You trade patterns, and they're supposed to give you an edge. It's just totally illogical. You look at a chart, you make money by following patterns, but the majority of traders do it. It's up to them if they wish to do it, but it's not a way to make money. Technical analysis, as I made this point in numerous videos, is only useful if you know what the fundamentals towards the sentiment is towards the fundamentals behind the chart. Then you can use very simple technical analysis just simply to get a good entry point and manage your trade. Now, myself and the trader I'm discussing here, we've got slightly different ways of using technical analysis, but both of us will keep it very, very simple. Okay. Now, in terms of point number 2, trade against the universal consensus, one of the main lessons from the book. If you've got the market in love with a Forex pair, that it's going to keep going up and they can see no end in sight to the trend, or it's going down, they can see no end in sight to the trend, everyone's bullish, or nearly everyone, or everyone's bearish, or nearly everyone, then look for a turning point. That's where George Soros's theory of anticipation comes in, which we'll come back to in a moment. Do not trade frequently. Traders generally will trade too much. They're trying to force money from the markets and they'll take low odds trades. How often should you actually trade though? Well, it's going to depend on your strategy. Trader I'm referring to in this video, once, twice a month maximum. Some months no trade at all, just waiting for really high odds opportunities. And that's what the axioms teaches you. We'd go for a few more trades, okay? But we won't do trades that don't fit our strategy or we're really confident in. Once you've got trades that you really like, do concentrated, meaningful bets in one or a few trades. Now, trader I'm talking about here will only do one trade at a time and risk up to 10% on the trade, okay? We will normally do we will sometimes just do one trade or one trade idea, but normally we'll have 3 or 4 on, but not too many. Okay, and our risk exposure is 5% as a general rule. We'll only go up to 10% if we're doing really well in the markets. In terms of when this trader is risking 10%, he will get out trades early. Okay, if the price action doesn't do what he thinks, he will get the stop up pretty quick as well, to reduce the risk of the trade. Now, in terms of what I'm saying here, it's okay to practice with smaller trade size until you're really confident in your trading strategy. But once you're basically confident, go for concentrated, meaningful bets. Don't spread yourself too thin. Make this point numerous videos. A lot of traders think, well, if I put on 10 or 20 trades, I kind of spread my risk around, reduce my risk and enhance my reward potential. You don't. If you've got too many trades on, you dilute your profit potential because your winners cancel out your losers. And I think traders, I know a lot of traders that I've spoken to over the years will have too many trades on. Just pick out the best. Which ones really match your strategy and which ones are you really confident in? Trim down the number of trades to one or a few. Also, when you're doing a bet size, it should hurt you a little bit if you lose. You don't expose your account to ruin, like bet 50% on a trade, but it must hurt you a little bit if you lose. Why? Because that will focus you on only picking the best trades that you're totally confident in, and it will focus you when you've got the trade open to abandon it if it is not doing what you want it to do. Like I said, the trade I'm just referring to, got no problem going into the trade. Price action doesn't do what he wants it to do. He'll get out with a small loss. He won't allow it to come back to his stop loss. It really focuses you picking the best trades and also managing the trade correctly in the market. If you just do bets that are so small, they mean nothing to you at all, you're not going to take good care of your money, are you? You're going to take too many trades probably and not be focused enough on what's going on in the market when you've got a trade that's open. Have an objective, go for it, and get out and have no regrets. That's a lesson from the axioms. It's a good lesson actually, because many traders, when they're making money, and they're making a lot of money, they take their eye off the ball and they think the trade is going to go on forever in their favour. They very often gear it up and just give back all their profits. Now, in relation to the trader I'm discussing here, we both did the British pound trade, which we've discussed in numerous videos, okay, or I have. And, great move to the upside he's gone when it gets to 126.50. It ran on to 130, but doesn't care because he's already cleared, 25% on the trade. Sure, could have made more, but got enough. Happy with what he got, can look for the next trade. So, have an objective. And what I would say is that, if you're in a trade and everything is looking really, really good, or your trade is going really, really well, that's when the markets are most dangerous and going to take your money off you. Okay, got to be alert. Having an objective is a great way of trading because we could all make more from the markets. The market's always right. We're always going to be wrong. You got you got enough you're happy with. There's going to be other trading opportunities. Now, why won't most investors do the above? Well, I think most traders, they have a real problem with the work ethic. They want to work hard. That's what we're taught in everyday society. Work hard. Harder you work, the more money you're going to make. But it's like legendary trader Jim Rogers said, most traders want to be doing things. In Forex or any type of trading, that's the wrong thing to do. Sit on your hands and do nothing until there's something to do. The work ethic does not apply in trading. Okay, it's very hard to stay patient. I think for most traders, us included. Certainly if we're in a slow period or we're in a period of drawdown, we want to get back. But you've got to restrain yourself and only wait for the best trades and be patient. Most traders are impatient. They want to make money. They've got unrealistic profit objectives. They'll want to try too hard. Also, they like to do comfortable things. Well, looking at a chart and looking for patterns, that's kind of comfortable, isn't it? 'Cause you don't have to think about sentiment fundamentals. That involves you thinking against other traders. Most traders don't want to do that. They don't have the confidence to do it. It's not that difficult at all, which we'll demonstrate in a moment. It's comfortable, isn't it? Just look at a chart, think you're going to make money. It's also not comfortable to go and trade against a universal consensus when you're bombarded in the media by convincing stories of why a trend should continue forever. That's not comfortable. It's not comfortable to do a bet size that's going to hurt you a little bit. It's much more comfortable to do a bet size that doesn't really matter, but that's not going to get you anywhere, is it? Also comfortable. It's not comfortable to get out of a big trend in motion at a profit objective and then see it run on. You've got the fear of regret. I've already said that doesn't really matter. It's not comfortable to come out early because you could always have had more. So, I think that's the reasons that people will find trading in a sort of Zurich type of way, for want of a better phrase, so difficult. But it is a great way to trade. I've said there's subtle differences between myself and how the trader I'm discussing here trade. You might say, why did he become a member of ours? Funnily enough, just to read our sentiment, not to look at our technicals. We do a lot of, obviously, sentiment research. So he wants to look at our sentiment, see if that agrees with what he's thinking. So just one little bit of our member centre is really of interest to him. So we're trading in different ways, but we broadly agree. Like I said, we're a little bit more conservative, made less money than he has, but everyone is different. I'll just make that point clear again. You've got to do things that you're comfortable with, that suit your trading, suit your personality. Right, let's go and look at a trade setup. And now the trade setup we're going to look at in terms of the theory of anticipation is going to be USD CAD. Chart of USD CAD. Now, in terms of myself and the trader I just discussed, we're both interested in this pair. We want to go long the USD and sell the CAD, basically. Now, we're both going to do it in slightly different ways, but our broad view is the USD should rebound. Now, from my own personal perspective, I'm looking at selling the CAD short on two other pairs. One of my favourites is in the guest pair section of the member centre. Now, it's all one trade. Just not sure which pair of the three the CAD is going to go down the most in, so I'll do all three, and basically I won't get the best, I won't get the worst. Now, in terms of before we do the technicals, let's just have a look at this quote first of all from George Soros. Now he says markets are not always right. Market is a good discounting mechanism most of the time, but not always. There are times when animal spirits run supreme and emotions overshadow reason. Trader psychology is going to push a move too far, and we personally think it's obviously to the downside in this pair. Markets constantly discount events that haven't happened yet. As a result, they'll often discount events that will never happen. And I think anticipation in this pair, one event for me certainly isn't going to happen. I shouldn't say certainly, but high probability isn't going to happen. Let's just go through the fundamentals of sentiment. I'll explain why. The market sees no cut in Canadian interest rates until mid-2020. That's a long way away, okay? 7 months away. It's discounted already, but I think the market is anticipating the cut coming too late. I think it's going to come way earlier. Why? Because if you look at Canadian data, business investment is slowing. That's a warning that the economy has peaked. Okay, Canadian economy is doing pretty well, but it's peaked, and I don't think the market's seeing this. Okay, also consumer spending is the weakest since 2008 in Canada, which basically major part of the economy, consumer spending being weak, will reflect in terms of economic growth. Okay, global economy is slowing. That will impact Canada because Canada is very exposed to global trade. Okay, so personally, I think Canadian economy is doing well, but it's basically peaked. And I think if you look at what the Bank of Canada is saying, they're already concerned. You can see it in their statements. The market isn't seeing it. They're going to cut interest rates probably, my view is, by the end of the year, January, and they're going to hint at it very soon. Okay, things are not getting better, so the market is anticipating something that isn't going to happen. And basically, if they don't cut until mid-2020, good news is in the price. Now, on the other side of the equation, you've got the USD. That's down on a potential rate cut from the Fed, which the market is seeing. Okay, that is next week. It's discounted by 93%. So the USD, this sell-off here, is due to the market seeing the rate cut by the Fed. It's almost totally discounted. I personally don't see them as odds on to cut rates. Okay, I think them cutting rates this month is more likely than Canadian interest rates being on hold until mid-2020. If they don't cut the Fed this month, it's almost totally discounted anyway. Now, the warning of a turn is if we look at the COT net traders positions, which is our favorite free sentiment tool in Forex trading, the smart money, the commercials, have accelerated their buying of the USD. It's a big move last week. Okay, at the same time, specs are selling hard against them. I put the biggest divergence in 4 years. It's actually the biggest divergence in 2 years, but the groups are going rapidly against each other. That points to a turn. Now, in terms of the sell-off, specs are heavily short. How much more selling is in this pair? I don't think too much, to be honest. My own view is this is support on the daily chart. I'm going to do the monthly chart in this video, but just below my support level is the key 130 level, which is a round number as well. I don't see that getting taken out for long. Okay, we could go down and go through the level. If we did, we'd look to buy on strength. Okay, at the moment I think we'll slow up into this level and turn higher. Just draw a trajectory in there. You've got basically quite a nice strong sell-off. These candles are pretty small. Okay, you've got a tail, body, tail, body. straight back through that level, break up, then I think we're going higher. Stop should be back behind the 130 round number, say 129.70. We break up, there's a lot of specs to be hit, in my view. We should gravitate up, then you can pull your stop up. Now, in terms of the first level that we should target, it's there, okay? So basically 133.20. So it's a really good risk to reward, and I think the probability of a break to the upside is pretty high. But due to the extremity of the COT net traders positions, I think, yeah, if we do break higher, we'll target here. We'll go back up to here. So there's a really good risk to reward trade in our view in terms of trading the long side. Obviously, you have to manage the trade as you go, but if you're going long this pair, you're looking for the specs to get run, okay? It's looking for a big blue candle, and then follow through to the upside. You bring your stop up. So at the moment, it's through that level. If we come down to the 130 level, start to steady, we go immediately long confirmation. The stop, if we go lower, will probably be not at 129.70, probably behind the next round number, 128.70. So looks good risk reward trade to us. And in terms of us studying the fundamentals and sentiment, we've done nothing complicated at all. It's all pretty simple. In terms of the Fed rate being discounted by 93%, that comes from FedWatch, CME FedWatch. It's a free tool. Just go and look it up for yourself. In terms of COT net traders positions, free tool. Just go and look at it. So nothing complicated. Technicals are simple. Okay, we're basically trading discounted news in our view, and anticipation. I'm certainly looking for that rate cut from Canada to come sooner than mid 2020. USD Fed cutting rates, not so convinced they might not do it this month, okay? But even if they do, I don't think they're going to be that keen to say they're going to cut rates going forward, which the market is also looking for. So for us, really good risk reward trade. Now, in terms of the Zurich axioms, a lot of people, they say, well, the book's old and they're not conventional wisdom. Personally, I think it's great investment wisdom. A lot you can learn from the book. Like I said, now what I'm going to do is play out with my favorite quotes from the Zurich axioms. I hope you enjoyed the quotes. I hope you go and buy the book, and also look up a little bit more about George Soros's theory of anticipation. But that is the video for today. Thank you very much for watching me as usual. Take care and have a good day.